So it's been a crazy time for uranium over the last few years. Certainly since late 2016, we were about $18 a pound of uranium. And today we're up near $74 per pound, or an amazing 311% increase over that period. And just really quickly, how we got there, from late 2016 through about early 2020s, we saw a number of production cuts in this market. We were obviously oversupplied as a result of Fukushima. And in 16, 17, 18 timeframe, we saw a lot of production cuts from the likes of Cigar Lake, Paladin's Langer Heinrich, pretty much all of the U.S. uranium ISRs scaled down over that period. So we really saw a period of sort of contraction on the production side. In addition, in Kazakhstan, we saw a pullback where they were at sort of 100% target range back in 2016. They were at about 64 million pounds, and they pulled back to much lower than that, to about the 80% target range, or they were down near 50 million pounds thereafter. And then COVID hit. And when the COVID pandemic hit, that further impacted things. The Kazakhs scaled down even further. We had even some suspensions in Cigar Lake over that time period. And that was just another impetus to push prices higher. We also saw shortly after the COVID-19 pandemic, we saw a lot of junior miners that were looking at moving into production in the years ahead, buy uranium at low prices during that period as sort of a hedge against their future production startup. So that sort of added pressure onto the market. And then, of course, in July of 2021, we saw the Sprott Physical Uranium Trust enter this market. And up through today, I believe they purchased well over about 50 million pounds of uranium, which really has pulled a lot of that mobile inventory that was in the market. It's basically sequestered a lot of that material. And then, of course, in late February of 2022, we saw Russia's invasion of Ukraine, and that further ratcheted price higher. We saw it jump up to about $64 per pound. It did fall back down after that, but as you know, the title of that slide, we've continuously seen higher highs and higher lows over that period. And then going into July of this year, we saw the coup in Niger, which is currently impacting Somaïr production, which is Orano's production. They produce about 5.2 million pounds a year. They've done about 70% this year. We think, it's likely that production will shut down for the rest of the year, and it's still in doubt what's going to happen going into next year, given the political situation there. Also, another development project there, Global Atomics DASA, which was projected to start up in 2025, could potentially experience some delays, so we'll see. So in terms of our uranium demand outlook, in our base case this year, we're at about 195 million pounds of demand. Now, I will caveat that with the fact that that does include our projection of inventory buildup, because we are seeing some inventory build continuing in China and some other countries. And that also does include some financial demand that we anticipate coming in the market from the likes of Sput, Yellow Cake, as well as some hedge funds in the market that have picked up physical positions. But as you can see there, by 2035, in our base demand case, we're looking at upwards of over 250 million pounds of demand, annual demand in the market, which is pretty significant. And I will caveat that with the fact that we're also pretty conservative, and I'm only showing this going out to 2035 because I think beyond 2035 you're going to have a lot more impact from SMRs, small modular reactors, and advanced reactors, probably early 2030s out into the future. So I would just say that there's a lot more potential demand there from that, but we'll see how things play out within that industry. As you see the chart on the bottom there, takes a look at pure reactor requirements overlaid with inventory buildup and demand up on the top. But even, especially from a pure requirement standpoint, those pure requirements increase 48% over the next 12 years. So that's pretty dramatic. And I will also note that in terms of who's sort of leading this demand increase, a lot of it is coming from China. About 85% of the demand increase over that period is coming from China. Other areas where we're seeing a little bit of growth, Western Europe, it's bringing back a couple of reactors in Belgium. We're seeing some additional reactors will come online in France over that period. In Eastern Europe, we're gonna begin to see growth in Poland, as well as some additional reactors in Czech Republic, Hungary. Those are the key areas of growth. In the Middle East as well, we continue to see growth in Turkey, as well as the UAE. We'll see more reactors in Egypt as well, and likely in Saudi Arabia, although that'll be further out into the future. So about a year ago, our president, Jonathan Hinze, he published a cover article called End of Inventory Overhang at the World Nuclear Association. And we really have seen inventory sort of tail off in this market. There's not a lot of it anymore. And as I mentioned earlier, a lot of it was due to the COVID mine suspensions, which led a lot of producers to reduce their inventory holdings during that period. So that was one big factor. And then, of course, the secondary demand, as I mentioned a moment ago, including the likes of Sput and Yellowcake, it's removed nearly 80 million pounds of demand from the spot market since 2018. So that's quite a big slug. And then we've continued to see a gradual work off in inventories in the U.S., Europe, as well as Japan brings more of their reactors back online. And we're also now beginning to see both U.S. utilities and European utilities begin to actually increase their inventory holdings. So when a lot of them are going out for RFQs now, they're not only buying for their normal uranium requirements, but they're looking above and beyond to buy some additional material to potentially place into inventory. And in terms of U.S. inventories, I believe those are right at about 28 months worth of inventory. So they're well less than 3 years now. European utilities are holding a little bit more, a little closer to 3 years. They're typically a little higher. But I don't think those numbers are going to come down anymore from where they're at, and I think they'll probably go back up in the near term. I'll just note that during the last sort of bull price run-up back in 2003, 2004 timeframe, when that happened, U.S. utility inventories were down at 6 months, and then we saw the price really ramp up to $136 per pound back in that time frame. And that period was also mired by a lot of production issues. There was some uncertainty, how quickly Kazakhstan would ramp up its production during that period. Things are a little different now, but certainly there's still room for I think prices to run in this current bull market. China and India both have added stocks China has purchased a lot of uranium, and we're continuing to see them be aggressive buyers in this market. We believe their inventory that they're holding sort of in country is upwards of 400 to 450 million pounds of inventory, and we don't anticipate them selling any of that in the market, mainly because they're going to need that uranium as their program continues to expand going forward. Government stockpiles, we really don't see any of those coming into the market in the near term. In fact, we anticipate that the U.S. government will actually probably in the future is more likely to be a net buyer of uranium to place into the U.S. uranium reserve. So that's certainly probably a very positive thing for U.S. producers as well as U.S. utilities to sort of have a backstop in the future. So, that last bullet point there, I would just say that, mobile inventories are at minimal levels, probably lower than I've probably ever seen them in the industry, and I've been in the industry since the late 90s, so certainly another very bullish trend. We continue to see growing geopolitical risk in this market. Russia's invasion of Ukraine has really changed sort of the contracting landscape, as well as sort of uranium material flows in the market. Since the invasion, we've really seen both U.S. utilities and European utilities really pull away from Russian SWU/EUP, and under the Russian suspension agreement, U.S. utilities were allowed to buy up to about 20% of their requirements as quote Russian SWU or Russian EUP. Well, they can still take deliveries under those contracts for now, and based off legislation that's in Congress right now, they'd likely continue to be able to take those deliveries through about, I think, 2026, 2027. But beyond that, they would no longer be able to take any materials. So what we're seeing now is a lot of U.S. utilities looking to quote unquote sort of replace that material. And so that's putting a lot of pressure on the market right now. And also the SWU market is also a big driver, because what we've seen is we're seeing U.S. and European utilities move away from Russian SWU. So that's placing more pressure on limited SWU that's available in the Western market from Urenco and Orano. And Urenco and Orano have been operating their SWU plants at pretty low operational tails assays. And with all this additional demand sort of coming this way from utilities, they're being forced to actually raise their operational tails assays to accommodate that additional demand. Well, when you raise operational tails assays, you need higher uranium feed. You need more uranium feed because you just don't have that extra available SWU demand. So you overfeed the plant with uranium. So that's placing a higher uranium requirement burden on utilities to feed more uranium through their contract for the same amount of end product EUP. So that's another big factor that's contributing to higher uranium requirements in this market. And then there's the impact of transportation of Kazakh material since the Russian invasion. So basically, a lot of Western utilities, they do not want to take Kazakh uranium that traditionally would flow through Russia and through the port of St. Petersburg going out to the west. So what we've seen is Kazakhstan work with a number of their joint venture partners in trying to move the material through the Trans-Caspian route. And there are some limitations there in terms of quantities that can be transported. So we're not really sure how that's going to play out, but there have been some delays in the deliveries. Cameco's had some material delayed. So there's some broader issues there in terms of material flows. Some of it could potentially be exported out through China, but that complicates matters because if it goes to China, then it actually has to physically change possession to Chinese, and a lot of suppliers just don't want to do that. So that's a big issue. Turning to Niger, as I mentioned, that's certainly been a big one. Processing's halted at Somaïr, mainly due to the shortage of chemical reagents. There's been some sanctions there, and so materials have been unable to cross the border to get to the plant. And then that's sort of complicated by France's political position with Niger as well. And then you've got Global Atomic's DASA project, which is expected to come online in 2025. I'll just note there that the U.S. lending agency, which is looking to help finance that project, has put on hold any potential financing there. So we'll see how things play out there, but it's certainly not positive. I know GoVX also has a project there. I think they're going to probably more focus on their Zambian project instead of Maduela. So things are certainly not super positive there. And then I'll note, that China, continues to acquire uranium projects across the globe. They own Husab, they own 25% of Langer Heinrich. They own Rossing now. So Namibia is pretty much almost 100% Chinese now, Chinese owned. And then in Kazakhstan, they continue to acquire projects. Last year they acquired the JV Ortalik, which includes the Central Minkaduk, as well as the Zhaopak JV that's now commencing production. And they have other joint venture projects in Semisbai as well as Irkol. And it's likely that there's another new project that would likely come online probably closer to 2030 called Inkai 3. And I'm sort of hearing rumors now that they would like to get their hands, or at least some ownership interest in that as well. So we'll see how things play up there, but China continues to be, acquirer of global uranium, and understandably, given just how broad their nuclear program is becoming. By the end of 2030, China's nuclear program will be larger than the U.S. So we have seen, quite a few restarts and new mine plans over the last few years, and led initially by McArthur River starting up. We saw UR Energy's Lost Creek commence production back in May of this year. We see Kazatomprom Zhaopak operating, and there are a host of others there that are projected to come online over the next couple of years. One thing I would note, however, is that based off history, we often see a lot of these mines sort of underperform. And so, I would just sort of take note of that going forward. Initial production plans are always quite positive, but it's not terribly easy bringing back a mine that's been offline for a while, or developing a new project. So, right now we primary production accounts for about 67% of global demand. We anticipate it'll be closer to 90% by 2025. Although, I would note that I bet that number is probably going to be a little bit lower in the 2025 period, just due to delays, underperformance, that kind of thing. And if we do see any shortfalls in production over that time period and production targets aren't met, and some of these producers that do have contracts could be forced perhaps to go into the spot market to buy more material, which could add to further upward pressure on price going forward. So production challenges and uncertainties. I just kind of noted it a minute ago, production plans are typically very or overly optimistic. You know, I would say a lot of times with new projects, the capital and operating costs tend to be a lot higher than what you'll see in a lot of the feasibility study estimates. So I would just note that. Supply chain challenges. We've seen lasting impacts from COVID in Kazakhstan. They've sort of been slightly delayed on well field drilling there. They've had some difficulty accessing some drilling equipment. We've seen material equipment shortages, rising input costs, sort of inflationary environment. So all of those have posed as cost increases for miners sort of across the world globally. And then, of course, there are regulatory environmental impacts that do impact mining. Obviously, certain jurisdictions it's more difficult than others. You know, if you're trying to bring on a new project in Canada, it's probably going to be a lot more difficult than trying to bring on a new project in Niger or Namibia or even Kazakhstan. So I would just note that. And then, of course, historically, we've seen obviously some anti-mining attitudes and environmental opposition, although I will say with nuclear looking greener and greener every day, I think it's becoming a lot more accepted than it has historically. In terms of development, there are project financing constraints. We typically see equity funding with a lot of restart projects and less so with new uranium projects. And with equity funding, there are typically initially a lot lower offtake positions, which allows those producers to have a lot more upside price exposure, although their stock price could be a lot more volatile. In terms of debt funding, we see those utilized more with new projects, but there, oftentimes the banks want to see offtake agreements in hand, so that naturally sort of forces some of these newer projects to do contracts out of the gate. So typically there's higher price security, but there's generally a little bit less in terms of upside, just because a lot of banks want to see higher levels of offtakes from those projects. But meeting production forecasts in the near term and medium term, you know, I'll note that given a lot of these challenges and uncertainties, we think will continue to make things difficult going forward. Really quickly, going to go through this primary production forecast. I think this year we're at about 141 million pounds of uranium globally. We were at about 129 million pounds last year. You know, over the next few years, I think by 2030, we expect to be up near 184 million pounds. But then we'll see that drop off to about 140 million pounds by 2035. Obviously, we'll see more production come into play out in the future, but exactly where that's going to be coming from has yet to be determined. One thing I will note, you know, there in the red, the Canadian production, that's pretty much driven all by the ramp up of McArthur River, Cigar Lake. You also see in green there in Africa, the majority of that increase over the next few years is driven by the ramp up of Paladin's Longer Heinrich, and the projected startup of the Dasa mine in Niger, which I mentioned earlier. In Kazakhstan, they're at about 58 million pounds this year. They've mentioned that they plan to go to a 100% production target by 2025. We're a little bit, I'm not sure whether they're going to be able to meet sort of the 80 million pound target they're talking about. I think a lot of that is going to come down to their Budenovskoye 6-7 project, which they initially said production could vary from between 2,000 tons to 6,000 tons of uranium. So there's a pretty wide delta there on that project. But we have them going up to about 76, 77 million pounds of uranium by 2025. I think that's probably a pretty fair estimate. But certainly in the future, there are a number of Kazakh projects that will roll off. And we'll start seeing higher costs emerge from even Kazakhstan. So here's our supply-demand outlook. And one thing I will note on there is in gray, the rapid deterioration of secondary supplies, which this year total about 48 million pounds. And as you can see, by 2035, that'll decline to about 19 million pounds of uranium annually. So a huge drop off there in secondary. And out beyond 28, 29, you see that supply-demand gap widen quite rapidly during that period. And so while production cuts were pretty easy to make from 2016 to 2020, we do think the ramp up of new production will have a much longer runway than the cuts that we initially saw. So in terms of our long-term supply outlook, we see our supply deficit expand from 21 million pounds in 2030 to 95 million pounds by 2035. In the past, we typically saw a lot of new mega project discoveries, but we're seeing fewer and fewer of these. I think the last couple being probably Arrow in Canada and the Husab project in Namibia. But since then, we just really haven't seen a lot. And I think a lot of that's attributable to the fact that we just haven't seen a lot of exploration, within the last 10 years or so. So that's a big one. There are some promising great projects. Obviously, NextGen's Rook 1, Denison's Phoenix, Fission's PLS, all look great on paper. I'll just note, they are all owned by juniors with limited development experience. So just how quickly those will actually come into production is somewhat debatable. And they're all in Canada, which is a more stringent regulatory environment than certainly Africa or Asian markets. And then obviously you've got, in today's market, higher lending rates than just 2 or 3 years ago. And there's obviously the stringent environmental management costs that have to be dealt with on the backside too, that often sort of go unnoticed, which definitely contributes to higher production costs going forward. Lastly, I'll note that we'll be seeing multiple ISR projects tail off in Kazakhstan in the 2030s. Really beyond Inkai 3, which we expect to come online probably in 2030, there are limited ISR projects in the pipeline. And I'll also note that these newer projects that we're seeing in Kazakhstan are much deeper than some of the other projects that we've historically seen. So like Budenovskoye 6-7 is probably in the 600 to 700 meters in terms of depth. So when you do that, your acid consumption rates are a lot higher at that kind of depth. So that results in your costs going up quite a bit. So with Budenovskoye 6-7, whereas some of the other Kazakh mines are probably sub 20, we expect that mine probably be closer to $40 per pound compared to some of the others. So I think going forward, we'll definitely see a lot of these Kazakh projects be much higher costs, and Kazatomprom is going to have to account for that. So I don't think you're going to see Kazatomprom be as an aggressive seller as they have been sort of historically, because they're going to have to account for that. And then lastly, Orano does have some joint venture projects, development projects it's working on in Uzbekistan and Mongolia, as well as its Niger. But I would just note that the Mongolian project probably won't come online until 2028 at the earliest. One of the issues that they're going to face there is they're going to have to either export that material. Well, it depends who they sell it to. The most likely target would be China. But if they don't sell it to China, they may have some transportation issues with that project, bringing it to the West, because it's either going to have to go through Russia or through China, and so that poses a potential problem there. Their Uzbek project, they just announced that they had a little bit of pilot production the other day, so that does appear to be moving along. But all in all, we're still quite bullish. We recently released our uranium production cost study back in September, and overall, we see much higher prices necessary going forward. So we think that the next round is we're going to need $70 plus term prices in terms of real dollars going forward, really to sort of incent the next round of production, as well as contribute to the next round of investment exploration in this market going forward to meet the strong demand sort of in that post-2030 period. So I appreciate your time today, and if you have any questions, I'm more than happy to take them.